Ever wonder why your stock portfolio suddenly takes a nosedive when you see a major headline about a far-off country? It's not a coincidence. Geopolitical events like wars, major elections, and trade disputes are some of the biggest movers and shakers of the stock market. You could have the most perfectly analyzed company, but a sudden political shift can throw all your predictions out the window. Today, we're diving deep into how these global events ripple through the financial markets and what you, as an intermediate investor, can do to navigate the turbulence. It's all about understanding the connection between world news and your wallet. So, if you're ready to get a better handle on these powerful forces, stick around. This is crucial knowledge for anyone serious about investing. Let us start with a recent and powerful example, the conflict in Ukraine that began in 2022, the moment the invasion happened. Global markets reacted almost instantly. We saw a massive spike in volatility. Why, first, think about energy. Russia is a major global supplier of oil and natural gas, especially to Europe. The conflict and the subsequent sanctions against Russia sent energy prices soaring. Companies that rely heavily on oil and gas saw their costs skyrocket, which squeezed their profit margins and sent their stock prices tumbling. Airlines, manufacturing companies, even some tech firms felt the heat. On the flip side, oil and gas companies themselves, like ExxonMobil and Chevron, saw their stock prices surge. It was a classic case of one sector's pain being another's gain. But it wasn't just about oil. Ukraine is known as the breadbasket of Europe, a huge exporter of wheat, corn, and sunflower oil. The conflict disrupted supply chains for these essential commodities. This led to a global food crisis and pushed food prices up. Companies in the food production and agriculture sectors were directly impacted. Think about companies like Archer Daniels, Midland, or Bunge. They had to navigate extreme price fluctuations and supply disruptions. This uncertainty spread to the broader market. The VIX index, often called the fear index, shot up, signaling widespread investor anxiety. Everyone was trying to figure out the domino effect, how sanctions, supply chain breaks, and humanitarian crises would ultimately impact corporate earnings and global economic growth. It was a stark reminder that our interconnected world means a conflict in one region can send shockwaves everywhere. Now, let's shift gears and talk about something that happens on a more predictable schedule: elections. Big national elections, especially in major economies like the United States, are huge geopolitical events in their own right. The 2024 U.S. presidential election is a perfect example of what investors are watching. Different political parties have vastly different approaches to economic policy, regulation, and international trade. For instance, a change in administration could lead to new tax laws. A promise of corporate tax cuts might boost the overall market as it leaves more money for companies to reinvest or return to shareholders. On the other hand, a proposed increase in corporate taxes could have the opposite effect. Investors are constantly trying to price in the potential outcome. Let's say one candidate is a strong advocate for renewable energy. UD likely sees stocks in the solar and wind energy sectors rally in the months leading up to the election, as investors bet on future government subsidies and favorable policies. Conversely, if another candidate favors deregulation for the fossil fuel industry, traditional energy stocks might get a boost. The same goes for healthcare. One party might want to expand government-funded healthcare programs, which could benefit certain hospital chains and insurance providers, while another might push for more private sector solutions, benefiting a different set of companies. The period before an election is filled with this kind of sector-specific volatility, as investors position themselves for the potential new political landscape. It's a high-stakes chess game played out on the stock market. So, you see these massive events unfolding on the news, and you see your portfolio swinging wildly. It can feel like you're just a passenger on a roller coaster you can't control. But you're not helpless. This is where hedging strategies come into play. Hedging is essentially like buying insurance for your portfolio. You're remaking an investment that is expected to move in the opposite direction of another part of your portfolio, helping to offset potential losses. One of the most common ways to hedge against geopolitical risk is by investing in safe haven assets. What's a safe haven asset? It's something that investors flock to during times of uncertainty. The classic example is gold. When fear grips the market, the price of gold often goes up. People have trusted it as a store of value for thousands of years, and that psychology hasn't changed. So, holding a small portion of your portfolio in gold, either through physical bullion, gold ETFs like GLD, or gold mining stocks, can cushion the blow if your stocks take a hit. Another safe haven is government bonds, particularly U.S. Treasury bonds. They are considered one of the safest investments in the world because they are backed by the full faith and credit of the U.S. government. During a crisis, demand for these bonds increases, pushing their prices up. Another sophisticated hedging strategy involves using options. This is for more advanced investors, but it's good to understand the concept. You could buy put options on a broad market index, like the S&P 500. A put option gives you the right, but not the obligation, to sell an asset at a predetermined price. If the market falls, the value of your put option goes up, offsetting some of the losses in your stock holdings. It's a direct way to bet against the market. However, options are complex and have expiration dates, so they require careful management. For most intermediate investors, sticking with simpler hedges like gold or diversifying into different asset classes is a more practical approach. The key is on to eliminate risk entirely. That's impossible, but to manage it so that one single event doesn't wipe you out. Beyond direct hedging, diversification is your best friend. But I'm not just talking about owning stocks from different sectors. I mean true geopolitical diversification. Are all your investments tied to the US economy? If a major political event happens in the US, your entire portfolio is exposed. Consider diversifying geographically. Investing in international stock ETFs can give you exposure to markets in Europe, Asia, and emerging economies. This way, if one region is going through a downturn, another might be booming. For example, while the conflict in Ukraine was causing turmoil in European markets, some economies in Southeast Asia or Latin America might have been performing relatively well. Another angle is currency. Holding assets in different currencies can also be a form of a hedge. If the US dollar weakens due to domestic policy, investments you hold in a stronger currency, like the Swiss franc or Japanese yen, could hold their value better or even increase in value when converted back to dollars. And don't forget about asset class diversification. Your portfolio shouldn't be 100% stocks. Mixing in bonds, real estate through REITs, and commodities creates a more robust portfolio that can better withstand shocks from any single direction. A well-diversified portfolio is like a ship with multiple watertight compartments. If one compartment gets flooded, the ship doesn't sink. Let's bring this all together. Geopolitical events are an unavoidable and powerful force in the financial markets. From the sudden shock of a military conflict like in Ukraine to the calculated uncertainty of a major election, these events create waves of volatility that can impact everything from energy prices to your favorite tech stocks. The key takeaway is not to be scared, but to be prepared. Panicking and selling everything at the first sign of trouble is almost always the wrong move. Instead, the smart investor stays informed. They read the news, not just the financial headlines, but the world news. They understand the potential ripple effects of global events. You need to build a resilient portfolio from the ground up. This means diversifying across different asset classes, sectors, and geographic regions. It means considering safe haven assets like gold or government bonds to act as a buffer during times of crisis. For those with more experience, it might even mean learning about advanced hedging strategies using options. By understanding these concepts, you shift from being a passive victim of market volatility to an active manager of your own financial destiny. Don't let the headlines control your emotions. Instead, use them as information to make calm, rational, and strategic decisions. Thanks for watching today. I hope this gives you a clearer framework for thinking about how world events affect your investments. It's a complex topic, but understanding it is a huge step forward in your investing journey. If you found this video helpful, please hit that like button and subscribe for more content on how to become a smarter investor. Let me know in the comments what geopolitical event you're watching closely right now. Stay informed, stay diversified, and I'll see you in the next video.